Good afternoon and welcome to this NISA webinar, 1 year in, assessing the government's economic approach. Almost a year to the day, we had the general election where Labour, then in opposition, won a seats landslide and has been trying to set the country on a different economic footing. It's talked a lot about the economic inheritance, about fixing foundations, about investing to repair public services and to kickstart growth and raise living standards in every part of the United Kingdom, as the Prime Minister promised in December. After 12 months, we want to take a view. How are the reforms going? Where are the areas where the government can and indeed needs to do better? What are some of the big drivers of the performance that we've seen over the last 12 months? I'm absolutely delighted that we're joined by so many of you here for this webinar, and equally delighted to have three brilliant colleagues giving presentations on this very topical question. Before we start with the presentations and before I introduce the three presenters, just to say that we would love to hear from our audience, from you. And if you have a question or indeed a comment, please use the chat and let us know what your question or comment is. And then once we've heard the three presentations, we will give you the floor to ask your question if you can unmute yourself. If you can't unmute yourself because you're on the go, then I'd be very happy to read out your question or your comments. And so that's what we'll do following the three presentations. The first will be by my colleague, Ben Caswell, who's a senior economist. He's going to talk about the macroeconomic assessment, really the fiscal picture and some of the big questions the country and indeed the government faces. He will be followed by my colleague, Ahmed Kaya, who's a principal economist. He'll be looking at trade and some of the international external pressures that have been brought to bear on the UK economy that the government has to deal with as well. And after Ahmed, it will be the turn of my colleague, Robin Smith, who's an associate economist. She will be talking about the implications for regions and for households. Each will speak for about 10 minutes, and then we'll have plenty of time for your questions and comments. So really, great pleasure to welcome you all. And now I'm going to give the floor to Ben for the macroeconomic assessment. Ben, over to you.
Thank you, Adrian. So what a year it's been. There's certainly no shortage of content here. And turning to our first slide, we can take a look at the economic backdrop and some of the fiscal implications. Now, the year has certainly flown by, and in her first speech as Chancellor just a few days after the election win, she mentioned that there were steps being taken to fix the foundations. Now, it kind of ended up that part of this strategy was a new fiscal framework, and part of that was to enable greater public investment. But as I'm sure you'll remember, the election took place on July the 4th, and the budget took place several months later, at the very end of October. There was 100 days, more than 100 days gap, in fact, between the election victory and the budget, which was actually the largest gap between a new government coming to power and their first budget since the 1970s. So I think that's worth mentioning because that sort of set the backdrop, actually, for a lot of the year, which was uncertainty. And during these 100 days, a lot of uncertainty did creep in, and it stayed with us throughout the year. As we've seen since the autumn budget, GDP growth has also come in weaker than expected, and inflation has also been a bit higher than expected. Partly this is due to global uncertainty, which Ahmed is going to talk about later on, but some of that is also generated domestically due to policy decisions and a lot of uncertainty stemming from the domestic UK economy. This erosion of confidence, both consumers and businesses, has led to the fiscal headroom being wiped out in March in the spring statement, and the Chancellor took measures to restore the 9.9 billion headroom then. And it seems likely that, given the way that things have panned out over the last 24 hours and before, that this headroom looks likely to be eroded once again come the autumn budget in October. So just let us remind us what the fiscal rules were and what the headroom is, just to set some of the context here. So really, we're looking at two rules, stability rule and the investment rule. The most important one is the stability rule, because that's the one that binds against the Chancellor's headroom. So the investment rule is a little bit easier to meet because you just need public sector net financial liabilities, which is a measure of debt, falling as a share of GDP. So that's okay, she's meeting that. But the stability rule binds a bit quicker, and that is that current day-to-day expenditure falls into balance. So taxes and revenues are met on current expenditure. This means that the government can borrow, but it's only for the purposes of net investment. Now, part of the strategy for fixing the foundations and economic renewal was an increase in public investment. And there has been an increase in public investment, as we saw in the spending review. There was a significant increase in capital expenditures, particularly in health, particularly in science and investment in AI and data centers and things like that. However, it's been quite a challenging time because, as we've seen, public finances have come in worse than anticipated. If we take a look at the OBR's medium-term forecast for 24-25 fiscal year, the overshoot was actually 11 billion by the end of that year, which severely eroded the 9.9 billion headroom already. In addition to that, if you take a look at the Economic and Fiscal Outlook report in March as well, the OBR forecast savings, cumulative savings, I might add, because we're looking at a 5-year horizon until 29-30 for this fiscal target. Cumulative savings from reform to incapacity benefits and disability benefits worth 13.7 billion. So that's over the lifetime of the Parliament, essentially, till 29-30, which is the Chancellor's target year. So this rolling forecast ends in 29-30. Now, 9.2 billion of that cumulative was stemming from PIP reform. And as we saw yesterday, this has been essentially watered down and kind of kicked into the long grass for a while. So we have this 11 billion overrun in fiscal year 24-25. In addition, we actually have a lower, even lower headroom, given that the full comprehensive reforms that were initially billed at the start of the last week were not passed. And there was a kind of workaround in order for the bill to get through. So this means if you take these two together, it seems likely that the stability rule is going to be missed again in October. Now, as I said before, it was missed by 4.1 billion in March. And then there were some tax and spend changes in the Economic and Fiscal Outlook in March to try and restore that headroom. But again, there's been another overshoot, it seems, given that public finances came in worse than expected, and the government has not been able to pass a comprehensive reform to welfare, incapacity, and disability benefits. Now, this is quite concerning because it has implications for the macroeconomy. Specifically, there's been a concern among businesses and consumers. Confidence has been very low, as I indicated earlier. And one of these concerns stems from potential tax hikes. Now, if we take a look back at the original manifesto pledges, there was a decision made by the then opposition, now government, that they would rule out any taxes on working people. And effectively what they were ruling out was increasing the biggest three taxes. Now, the largest three taxes, which are income tax, VAT, and national insurance on employees, these actually make up the bulk of the government's revenue. It's about 2/3 of the government's entire revenue. So if you're making a pledge not to touch any of these big three taxes, it's actually very hard to move the dial and raise significant amounts of revenue. And as a result, we had these workarounds and we had these smaller tax changes and very, very narrow headroom as a result. Now, as we've said, and as the OBR pointed out, the fiscal headroom of 9.9 billion is actually well within the average OBR forecast error. So we knew that these margins were razor thin to begin with. Now, the difficulty is that every 6 months we're having these fiscal events. And one of the key themes that were highlighted in CFO surveys, if you take a look at Q4 of 2024 compared to Q1 of 2025, is that the ranking of tax hikes and the concerns about the tax burden jumped quite dramatically. So the number of CFOs that said they were significantly concerned about future tax increases rose from 14 to 31%. And this has quite significant implications for hiring decisions as well as investment decisions for firms in the UK. And we know that to have a really robust and growing economy, you do need to have increases in investment. The UK has historically quite low levels of investment. In addition to that, you need to have robust employment growth as well if the economy is to grow. So just to summarize and move on to the last slide, what's next if the rules are not being met? There are a lot of moving parts here because whether you meet the 9.9 billion headroom depends crucially on how much you can spend and save, but it also depends on how quickly the economy grows, because if the economy grows more quickly, then you'll have more tax revenues being raised by virtue of more activity taking place. Now, we've seen that GDP hasn't performed so well. And in addition to that, it's been hard to actually meet some of these pledges made to scale back expenditures. We saw the U-turn, for example, on winter fuel allowance, making it means tested. And also we saw yesterday the decision to scale back on some of the more extensive welfare reforms that were originally touted. Now, what are the next steps from here? Well, there are really four kind of options on the table for the Chancellor. None of them are particularly enviable or desirable. I don't really wish to be in a position like that. But the first option is that you could scale back expenditures in order to create an additional buffer against the headroom. Now, this is a probable option, but it's also politically quite unpopular. I don't need to relitigate the events of the last 24 hours to indicate that. The other option is that you could raise taxes. As I alluded to earlier, there's been the pledge not to raise any of these big three taxes. And also, it may be unpopular politically in the sense that people don't want to pay a higher income tax or higher VAT, etc. But if I'm being totally honest, I think that raising one of the big three taxes would obviously be the most desirable outcome in terms of filling the gap between revenue and expenditure at the moment, at least in the short to medium term. Now, the other two options are less probable, but still perhaps on the table, which is that you could change the rules again. Personally, I don't think that that's viable right now, given that the rules have been changed just less than 12 months ago. And it kind of creates credibility risk, and it would obviously concern markets. The other option is that you can move to an annual fiscal event to stop these kind of piecemeal tinkering every 6 months. That would require primary legislation, given that the OBR produces a forecast every 6 months by statute. So the options on the table for the Chancellor, really, if I'm being honest and realistic, in the autumn budget are most likely significant tax rises, one of the big three, perhaps with some combination of scaled back expenditures. But that pretty much leaves us where we are today. And then I'm going to hand over to Ahmet to give a summary of where we are today with regards to the international perspective and the global perspective. Thank you.
Thank you very much, Ben, for this great presentation. Good afternoon, everyone. So I'm going to talk about current trade outlook and the external challenges that the UK economy has faced over the last year. So let's start with our trade forecast. Recent trade figures by ONS shows that total trade deficit widened by approximately £5 billion to £15.6 billion in the 3 months to April, which is the highest point since July 2022. And that's mainly because imports rose more than exports for both goods and services. Although we expect exports to grow positively this year, this is mainly because of the price effect, and the rise in exports will be more than offset by the increase in imports. As a result, we expect net trade contribution to the annual GDP growth to remain negative this year, as you can see from the right-hand side chart. However, we expect a strong recovery in export volumes next year. And this is partly thanks to new trade deals and the recovery in EU market, which is the UK's largest trade market. Therefore, we expect net trade contribution to the growth to be positive from next year onwards. That's a brief overview of how we see the developments in foreign trade and how we forecast the external side of the UK economy. Now I'm moving on to some of the shocks that the UK economy has faced last year. Specifically, there has been 3 major shocks that has had significant impact on the domestic economy over the last year. The first one is the US import tariffs and the huge uncertainty about global trade policies. As we know, the President Trump imposed 10% blanket tariffs against all countries, including the United Kingdom, and up to 54% tariffs against China. And he also imposed specific tariffs on steel and aluminum, and automobiles, and some other particular goods. But and some of those tariffs was reversed, and some of them was reduced. But the current level of effective US tariffs are at their highest levels over the last century. And the second shock is the tensions in the Middle East, which has again escalated after the Israel strike against Iran last month. And the final shock that I'm going to talk about is the turmoil in global bond markets. So I'm going to talk about each of these in more detail. Starting with trade policies, as you know, the US President Trump imposed substantial tariffs against all countries, particularly China. And some of these tariffs, as I mentioned, were then reduced, some of them are lifted, and we still expect lots of trade deals to happen. But for now, the US effective tariff rate is increased to the highest levels since the Smoot-Hawley Tariff Act in 1930, as you can see from the chart on the slide. For the UK, tariffs impact can come in three different ways. The first one is the direct effect of 10% tariff, which will affect all goods exports in the United Kingdom. Although we do not expect this to have a huge national impact, which I will discuss later, the sectoral and regional effects are more important, as we discussed in our recent UK economic outlook. And the second way tariffs can affect the UK economy is through the global spillover effects. So by that, I mean that because of higher tariffs, we expect slower global economy, especially slower growth in the European Union, which means that their import demand from the United Kingdom will be lower as well. And the final impact is on inflation. And on inflation, there are two contradictory views on how this will happen. Some argue that if China and others won't sell their products in the United States, they will sell their products with a discount in other markets, including the United Kingdom market. So the impact would be deflationary. And the counter argument of this is the role of exchange rates. If the US dollar appreciates due to lower trade deficit and strong domestic economic performance as a result of these tariffs, all the goods that the UK residents import from all other markets will be more expensive in domestic currency, which will eventually be passed on to the consumers. And so far, we haven't seen the appreciation in dollars. So this inflationary effect through the exchange rates may be limited. We have done some simulations of announced tariffs using our global macroeconomic model earlier and find that the UK GDP growth will fall by about 0.2 to 0.6% this year and next year, based on different assumptions. But when it comes to inflation, as you can see from the right panel of the chart, the impact is almost negligible, and even negative if we consider the deflationary pressures from lower oil prices, which is again due to the slower global GDP growth prospects as a result of those tariffs. So what the government has done so far? Actually, they did a lot. First of all, they managed to finalize the long-standing UK-India free trade deal. And then they quickly made a deal with the United States to lower some of the tariffs that Trump imposed earlier this year. And finally, they made another trade deal with the European Union to reset the relationship since Brexit. So trade deals with the United States and the European Union are not so comprehensive, and they definitely won't reverse the previous damage due to the US tariffs or due to the Brexit, but all these are steps into the right direction. When it comes to free trade deal with India, this is one of the most comprehensive trade deals and will eliminate tariffs on 90% of UK exports to India. According to some estimates by the DBT, this deal may increase the UK GDP by almost £5 billion per year in the long run. So the impact of this trade deal with India is quite comprehensive and very beneficial for the UK economy over the long run. And overall, the government has been very proactive when it comes to trade policies. Moving on to the second shock, which is the Middle East tensions. And this mainly affects the UK economy through higher energy prices and potential pass-through because of the rising shipping costs. Our simulations based on the Institute's global macroeconomic model show that if oil and gas prices rise by 10%, then UK inflation increases by approximately 0.3 to 0.4 percentage points in almost a year, as you can see from the left-hand side chart. And another analysis my colleagues and I did on shipping costs also shows that about 10 percentage point increase in shipping cost inflation increases inflation in OECD countries by about 0.5 percentage points. This is after controlling for oil and gas prices. So if the situation escalates, the tensions in the Middle East can push UK inflation up by close to 1 percentage point. So this is almost purely an external shock, and there is not much that the government can do about it. But beyond these external shocks, domestic external pressures are already too high. And that's mainly due to the increase in national insurance contribution and the asymmetric increase in national minimum wage in April. My final point is about the sell-off in the global bond markets. There has been significant volatility in the bond markets last year and in spring this year, pushing the long-term borrowing cost to the highest level since the global financial crisis, as you can see from the chart on the slide. And the main drivers of this volatility are, first of all, concerns about the public debt sustainability in almost all advanced economies, and uncertainties about trade and tariff policies in the United States and how will other countries retaliate to these policies. And there are lots of concerns about the erosion of US dollar's safe haven status, which also pushed investors to move away from the US treasuries. And finally, the quantitative tightening policies in most advanced economies. And when it comes to the UK context, most of these issues also apply. Ben already discussed the fiscal issues in the United Kingdom, but it is important to stress that we have over 100% debt to GDP ratio, and taxes are already at their historically high levels. And more worryingly, as we see from recent discussions around welfare cuts and the spending review, there is no real political will to cut spending that could make the fiscal position sustainable going forward. All in all, this is probably the most important challenge for government to tackle going forward. So I'm going to stop here and hand over to Robin to discuss more about the spending review.
So on the 11th of June, the Chancellor delivered the comprehensive spending review, announcing a far-reaching multi-year spending plan. Although no changes to tax policy were made, the allocation of spending is crucial to setting the tone for the autumn budget. So before we go into a brief analysis of the spending decisions, it is important to understand the economic context prior to the spending review. So a crucial aspect to take into account is the implementation of the increases to employers' national insurance contributions, which came into effect this April. So these take the form of raising the employer's national insurance contribution rate from 13.8% to 15%. The lower threshold to which employers will pay national insurance contributions was lowered from 9,100 to 5,000. The maximum amount of employment allowance that can be claimed back has risen from 5,000 to 10,500. In addition, the previous threshold, which employers were eligible, which meant if the employers were eligible, was if their national insurance contribution liability was less than or equal to 100,000 a year, has been scrapped, meaning more employers are eligible to claim for the employment allowance. Although this may not be a direct tax on the working people, there are several implications of raising this tax. So as we can see from this graph, relative to Q1, i.e. the start of this year, our NIGEM model has estimated the impact of the rise of the employer national insurance contributions with regard to key economic variables. So we can see that it increases inflation interest rates and reduces growth in employment. So keeping this in mind, the Chancellor will be wanting to squeeze as much economic value as possible from every pound spent. So implications for regions and sectors. Overall, increased investment in housing, transport and defence will help boost economic growth in some of the less prosperous regions of the UK, such as the West Midlands, Wales and the North East. So this is a welcome first step towards narrowing the huge gaps in capital stock that are holding back poorer regions and poorer towns. Investment in capital stock is important for increasing the operational capacity of the economy, making it more productive. So some notable announcements include the cash injection of 39 billion over the next decade into the Affordable Homes Programme, which actually translates to 3.9 billion a year. So this is quite a stark contrast to the Centre for Economic and Business Research findings that even if the government only covered a proportion of the money needed to fund the building of 90,000 socially rented houses a year, it's estimated to be 11.8 million, which is a lot more than 3.9 million a year. So in addition, the addition to invest 15 million into the north to improve transport connectivity is welcomed, although it's still unclear whether this will be sustained. This will help balance earlier decisions to concentrate infrastructure spending, such as the additional runway in Heathrow and the growth corridor between Oxford and Cambridge. Nuclear power experiences a windfall of 14.9 billion, which includes the 2.9 billion announced in the autumn budget last year to build the Sizewell C nuclear plant. So I think it's important to bear in mind, although a lot of billions were spoken about in the budget, these are billions over a number of years. So when we actually convert this into by year, it's a lot less than it seems. So this gives not as much confidence the private sector needs to invest, which is really important, bearing in mind the current fiscal constraints. For example, the 14.9 billion to invest in the nuclear Sizewell C plants only actually translates to 5 years of the project, and it's a decade-long project. So it is paramount that investment is sustained, giving certainty to the private sector and hopefully crowding in private sector investment. It's also unclear where house building will occur and how this will be decided, in order to get the greatest boost to growth and living standards alike in all parts of the country. House building should be aligned to transport connectivity and vice versa, as well as other infrastructure, such as schools and GP practices. So implications for households. So although the Chancellor reiterated the government's commitment to boost living standards in every part of the UK, there was no actual mention of wages, with the exception of the public sector wage deals. So wages are a key driver of living standards. In addition, a key omission from the spending review is funding for pathways to help people back to work who are economically inactive. Although the Chancellor continues this rhetoric of no taxes on working people, this isn't strictly true when we consider the fiscal drag experienced by households due to the continued freezing of the personal tax allowance and income tax bands, meaning that more people are paid into paying more tax than they otherwise would if it was adjusted for real. In addition, by increasing employer costs, this may have a disproportionate impact on young people, as employers reduce the numbers of job opportunities for people entering the workforce, as well as disproportionately affecting the low productive and labour-intensive industries such as retail and hospitality, where the concentration of young people is the greatest. This also contradicts the Chancellor's open remarks about not putting the burden on younger people. So it's important to think long-term and how intergeneral transfers are going to come about. Overall, it's not clear how the spending review will boost living standards for households by the end of this Parliament. So lastly, just to bring me on to final thoughts, increased investment in the NHS, defence and housing and transport infrastructure could boost economic growth in less prosperous regions. However, major infrastructure projects continue to be in the South East, namely the Third Heathrow runway and the Oxford to Cambridge Growth Corridor. Allocation away from the HS2 is likely to yield productivity gains. The public sector should prioritise projects that generate positive spillovers into the private sector, but balancing this with ensuring that regional inequalities aren't deepened. So they can do this by identifying key opportunities outside London and South East. For example, identifying regions' industrial strengths, such as clean energy in Wales and Scotland, and also a manufacturing industry in Yorkshire and Humber. However, it's almost inevitable that taxes on the working people will have to occur to avoid a downgrade in OBR's autumn forecast. So this is very likely this will happen coming into autumn this year. So.
Great. Thank you so much, Robin, Ahmed, and Ben, for 3 really, really great presentations. We will now come to the questions, and we've got some of them already in the chat. So I'm going to ask whether John-Paul Ford-Rojas would like to unmute himself and ask his question or make his comments. John-Paul.
Hello. Yeah. There's been some intense speculation just in the hour or so before we started, as Rachel Reeves was emotional in the House of Commons, and Keir Starmer apparently at the time refused to give her back, and we don't know what that's exactly all about. But I wonder. The bond market certainly responded, and yields shot quite a bit higher. I just wondered if we could discuss what the implications might be for potential new Labour Chancellor, and what that might mean for the public finances, bond markets, confidence, etc., or anything else that it might imply.
Okay, thank you very much, John-Paul. Ben, would you like to take that question? And
Yeah.
I have some thoughts as well, if that helps.
Yeah, absolutely. Yeah, thanks, John-Paul and Adrian. So I wouldn't obviously speculate about the occupancy of number 11, but what I would say is that essentially the current trajectory is not sustainable. That set of policies is not sustainable. Either you have to raise taxes, or you have to cut expenditure, or change the rules. Changing the rules looks unlikely, given that it's already happened in the last 12 months. Having growth come in very, very high and better than expected also looks fairly unlikely as well. So what I would say is that essentially that set of policies can't continue throughout the rest of the parliament. There would have to be some change on those policies. Now, what that would mean for the occupancy of number 11 is a totally political matter, and how they decide to go about that it's entirely up to them. So I wouldn't speculate about any position in the cabinet or the structure, composition of key roles in the government as is. But Adrian, would you like to have a word on that as well?
Well, I mean, really, to very much to paraphrase what you said, which is this is about economic strategy. This isn't about the personnel. You can change, a chancellor or prime minister, but if the policies stay the same, we'll be facing the same tensions, the same trade-offs, the same problems. So what we're really saying is that the UK's economic performance is very much the outcome of domestic drivers. That the international situation is not what's affecting low growth, flatlining productivity, and stagnating living standards. It's a domestic matter. And the question is, what are domestic responses? And as Ben has said, this is a question for the government as a whole. How is it going to adjust tax and spend? How is it going to bring about other reforms to stimulate growth and to kickstart productivity and raise living standards? So it's about the program. It's not so much about, who's in number 11 or anywhere else. So let's see what the government comes up with. I think what's really coming out of Ben's presentation very, very strongly is just the increased speculation, between fiscal events as to what's going to happen. So after the budget, we were speculating for 6 months in the run-up to the spring statement. After the spring statement, we were speculating for 3 months in the run-up to the comprehensive spending review. Now we're thinking what's going to happen in the autumn budget. This just adds uncertainty and instability when actually policy should be absorbing shocks, it should be reducing uncertainty. So really, this is a question, about better economic policy. But John-Paul, you want to come back in, please?
Yeah, just that the markets are taking a view on this, which appears to be that even if it's not about, even if the underlying issues remain the same, that a replacement for Rachel Reeves may be perhaps looser in terms of fiscal policy than the current incumbent. That's just my interpretation of what gilt yields are doing at the moment, which does seem to suggest that markets do think there are implications about who the occupant of number 11 is.
Okay, so what I would say on gilt yields is that there was a small uptick today. Say 10-year yield was 4.5. It sort of crept up to around 4.6. Now, that's not the same as the episode that we saw in January, where the bond market had a wobble and it went up to 4.9 and then came down again. So I wouldn't overread into small movements like that necessarily. A small movement like that of, let's say, 10 basis points puts a small amount of pressure on debt interest payments, but it doesn't completely break the bank. So I would sort of allow the dust to settle from the 24 hours that have just passed, and then make an assessment of how the bond market looks perhaps in a week or two, and see if it's still up there or not.
Thank you.
Great. Thank you so much, John Paul, for that. The next question is from Harry. So could we please unmute Harry, if you can come in? And Harry, you have the floor.
Hello. Thank you for doing the talk today. My question was primarily for Benjamin, but I think for everyone really. To what extent are we close to reaching a point where increased tax rates don't produce increased income? And kind of linked to that, to what extent are we on the precipice of a lack of a complete crisis of confidence in the bond markets? I think these two are kind of questions that are kind of linked together. So I'm just kind of curious to hear your opinion on how much tax there really is left to squeeze at this point.
Great. Thank you, Harry. Really, really interesting question, like John Paul's before that. Ben, over to you.
Thanks. Yeah, thanks, Harry. So yeah, it's a great question. I understand that, of course, there's a kind of Laffer curve type effect, and people will make the argument that if you raise rates too high, then of course you disincentivize productive behavior and economic activity, and then that can essentially stop raising the tax rates actually affect raising revenue. So I understand the argument being made here, but I don't think we're necessarily quite at that point. Now, nobody wants to pay higher taxes. Nobody does it for just the love of paying taxes. However, there are lots of second order implications here. So what I would potentially explore is in the short to medium term, let's say 25, 26, and then 26, 27 financial year, potentially raise one of the big three taxes and make a big statement, and then guide markets and guide people that follow, our space very carefully, and tell them, well, we have a plan. We're going to raise taxes in a big way in the short, medium term to get this situation under control. And then we're going to gradually taper off these tax rates over the remainder of the parliament, so in the second half of the parliament. Now, that's not completely unreasonable. You're giving some sort of forward guidance, and you're building up a big buffer in the short term. And what we've seen really over the last, let's say, 12 months is quite a significant amount of fiscal fatigue. Now, these rules are certainly not perfect. Does a perfect set of fiscal rules exist? No. Are these rules better or worse than the last ones? That's up to interpretation. But what I would say is that once you've established the rules, the most important thing is to build up credibility against those self-imposed rules. If you set yourself a target, if you consistently meet it, that sends a signal to the market that you're serious. If you're having to change course, and if you're having to tinker, and if you're having to make piecemeal ad hoc adjustments every 6 months, that doesn't convey credibility. That doesn't send out a good signal. So regardless of what the rules are themselves, it's about creating this fiscal buffer and credibility against what you've said that you're going to do. And more important than anything else is that at the moment, I think, just to steady the ship and to steady the outlook. And you can, again, think about lowering taxes towards the end of the parliament. But I think in the medium, very short term, to stabilize things, there should be serious consideration of raising one of the big three taxes in the autumn budget.
Great, thank you so much, Harry, and thanks, Ben, for the really comprehensive answer. Next is David Cobham. Can we unmute David? David, when you're ready, please go ahead.
Okay, my question is this. It seems to me clear that the Labour government's fiscal problem derives very heavily from what was really essentially a dirty trick that was played by Hunt in the run-up to the election, where he lowered these 3 big taxes and said and challenged Labour not to increase them. Presumably the long-term way to prevent that kind of thing is to give the OBR the right and the duty to examine alternative policy scenarios, particularly those in manifestos in the run-up to an election. But if we go back to 2024, I'm trying to think whether there's something else that Starmer and Reeves could have done. Would it have worked for them at that point to challenge Hunt and say, okay, if you spell out the spending cuts that you're assuming in detail, tell us exactly what this means, then we'll tell you whether we're prepared to stick with those tax cuts?
Yeah, it's another really great question. And just before I bring Ben in, I mean, one thought is the previous government reduced employee NIC contributions twice, once in January and once in April of 2024. And I suppose any opposition, is always able to say, well, we might go along with one of those NIC cuts for employees because people have had it tough, inflation's gone up, living standards have struggled to keep pace and so on, but maybe not with the second one. And that at a stroke would have been 10 billion. So the question is, does the opposition always have to follow the government in what it decides on tax cuts? And yeah, there are certainly options. And I think it's fair to say that the last general election campaign was not exactly a great example of transparent tax and spend plans by any of the parties. And I think that was not to the credit of the parties in this country when we needed to have a serious debate about choices and options. The party manifestos seemed very, very light on what was going to happen after the election. So I think it's a really good question. Ben, or any other thoughts on David's point?
Yeah, thanks, Adrian. Yeah, I'd echo similar points and potentially add that there has been talk about empowering the OBR and potentially extending the scope and capacity of what the OBR does. But that's really more of a sort of political debate potentially at this point. Now, you could also mention the fact that there was these kind of pledges not to raise these big 3 taxes in anticipation in run up to the election. Again, a lot of this was more political maneuvering in anticipation of the election day. So I think really what's important is that the decision whether to stick with the manifesto pledges and the extent to which it binds the fiscal situation. And that's really where I'd come at it from. I think the rest is more of a political discussion than an economic discussion. And the way that I think of it at the moment is that we've got a set of constraints, which are economic and fiscal. And the question is, regardless of sort of how we got there here, but what are the steps forward? Potentially empowering the OBR is one of them. And I know that Rachel Reeves did take some steps to give the OBR additional powers. For example, you cannot break the fiscal rules unless the OBR certifies that there is indeed an economic need to do so, or an economic crisis. But some of these additional things to expand the scope of the OBR would require significant political debate and potentially even primary legislation in some cases as well.
Thanks, Ben. And David, please come on in.
If I could just come back quickly, I mean,
please.
What I think is important in a more general sense here is that we don't allow the political right wing to talk as though public expenditure has no value in itself. And that's heavily embedded in some forms of macroeconomic models, and I think very badly so. But we shouldn't allow that in a political debate. So we should, as it were, the left and the Labour Party should always be saying, but but public expenditure is valuable. Okay, you want to cut taxes? Yes, well, in a nice world, we'd cut taxes, but you have to think about the consequences. And somehow the way in which Starmer and Reeves allowed Hunt to get away with this, they didn't raise that issue. They didn't say, oh, yes, but what is this going to do to the NHS or whatever it is? And they could have done that. And then life might have been different.
Well, David, this reminds me of what the the chair of the OBR said, I think, when asked by the Treasury Select Committee what he thought about some of the plans or lack of plans, and I think he said it was beyond a work of fiction. So yes, absolutely, the state of the economic policy debate has not been nearly good enough. I think there's value in public spending for sure, as we've certainly said in relation to funding public service properly, especially for those bottom 40% of households who depend on the public services disproportionately. There's of course also a lot of value in public investment because it drives up growth and it unlocks business investment. And I think absolutely it's incumbent on politicians and policymakers to make the case why public spending and why public investment are necessary to boost growth and doing so. That's great. Thanks so much, David. Let's now bring in Phil Aldrich. Can we give Phil the floor? And Phil, welcome back.
Yes, hi. I'm not sure whether I put the questions in the chat, but it's yeah, is Rachel Reeves' position untenable because of what's happened over the last few weeks with two major policies being unravelled? You've got any thoughts about, who is more credible than her? I mean, you have kind of hinted, Adrian, that if you change the personnel, it doesn't make any difference if the policies don't change. And did I miss it? But did you estimate the size of the potential black hole? And are you expecting a productivity potential output downgrade from the OBR?
Well, three really, really good questions. For the second and the third, I'm going to turn to Ben in just a moment, if I may. I mean, on the first one, it's really what we've already said, Phil, which is, what we're interested in is the economic strategy. What is it that can unlock growth, that can raise productivity and living standards in the course of this parliament, and what are the levers that government can pull to do so. We are not going to speculate about either the Chancellor's position or alternatives. Really, the question is, what is the government's approach? And if I may, just to flag that on the 9th of July, so a week today, we're launching a whole publication that we've done together with colleagues at the Productivity Institute on what should be the pro-productivity policies that this government can and should implement between now and the next election. So clearly, there are these policy options and choices on the table, and we want government in the national interest to make different choices that can do so. But on the question of personnel, we leave that to others who are much better qualified. So Ben, on Phil's second and third question, black hole and also productivity downgrade by the OBR.
Yeah, absolutely. Yeah, thanks for the question, Philip, and echo what Adrian said as well. You've got a set of economic objectives that you want to achieve. How you politically operationalize that to achieve that is entirely a matter for political discussions, and that's a discussion which the Labour Party will have internally. So really, we're just thinking about the actual matter of fact of the numbers and the constraints that that the government faces at the moment, rather than who is particularly in post at some given point. So in terms of the black hole and in terms of potential shortfall against the rules and productivity forecast of the OBR has a more generous forecast for growth and productivity. We all know that. On average, over the forecast horizon until 29-30, they've got an average growth rate of 1.7, which is pretty strong. Ours is much lower. It's towards 1.4 average over the same horizon. So that's 0.3 percentage points lower in terms of growth. What that means is that in our last economic outlook is that there was a 57 billion shortfall in 29-30. Now, that's given the OBR spending path set externally. So we take the OBR spending path and we impose that. And then we've got our own growth rates and we've got our own taxes, and everything responds to that in our global econometric model. Now, that path assumes that there are no other decisions taken by the Chancellor, so that spending path remains exactly the same. The tax paths don't change, so everything else is just set. So that 57 billion opens if nothing changes, okay? But in terms of the shortfall in autumn, It's likely to be obviously much lower than that, but there is likely to be a shortfall. And as I said, we can already take a look at the OBR's economic and fiscal outlook for March 25, and we can see that there was an overrun in the financial year ending 25 of 11 billion already in public sector national accounts. So the 9.9 is pretty much already erased because of that. In addition, we had the vote yesterday. If you took the cumulative original intention over the parliament, the OBR scored that as around saving 13.2 billion over the entire parliament. That's been significantly watered down, potentially by a half. So if you add that back on, you're already looking at being, let's say, 5 to 10 billion in the red already by the autumn. And that's not even considering growth outturn and inflation as well. Inflation has come in slightly higher than expected, growth perhaps slightly lower than expected relative to the start of this year. So I'm purely talking about tax and spend. I'm not even talking about GDP at the moment. And I think we're already looking at a 5 to 10 billion shortfall in the autumn.
Great, thank you so much, Ben. Phil, thank you very, very much indeed for those three really great questions by all the others. We've had a question from Patrick Tour, and I wonder whether Patrick is able to unmute himself. Now, some of what Patrick is asking about, I think, is also Phil's question. But Patrick, please, if you would like to ask your question and perhaps add something if you want, but please go ahead.
Yeah, I mean, the OBR yesterday basically put their hands up, didn't they, and said, we've got it wrong consistently when it comes to estimating economic growth and productivity growth. And as you just said, Ben, that if you just project out from that, then you come up with a big number of for the shortfall. Is there anything that can be done to correct the OBR's course rather than just the government's course? Because the two sort of go hand in hand. If it's consistently getting its estimates wrong, what can be done to correct that, if anything?
Right. Yeah. Thanks, Patrick. Ben.
Yeah, well, the OBR is an independent body, and through legislation, it's mandated to do 2 forecasts a year. So that remains the same. That remains unchanged. With regards to the accuracy and forecast errors, the OBR is pretty transparent, and a lot of their data is easily accessible on their website. So they're quite open about the average forecast errors that they run into. Whether there needs to be a change in the method, I don't know. That's entirely up to an internal discussion with the OBR. But what I would say is that in terms of credibility, if you obviously have consistent forecast errors, then that weakens the credibility of said forecast. So it's important for preserving the integrity of the OBR, and it's also important to preserve the function of the OBR as a gold standard signaling device for credible UK forecasts, both for economic and fiscal matters. I think to preserve the integrity and credibility of those forecasts, it's obviously important that forecast errors remain to a minimum. How the OBR want to actually arrange that, or how they prioritize that, is entirely a matter for internal and political discussions. But it's not something that can be entirely sort of solved by economic tinkering. It's an internal discussion, and it would require significant legislation in some cases if the OBR was to be significantly extended in terms of its reach as well.
Great, thanks, Ben, very much. Patrick, thank you so much for that great question. Next is Chris Longley. Can we bring in Chris? And is Chris able to unmute himself? Chris, over to you. Great to have you back.
I hope so. One of the major aspects of all of the discussions of this last year has been the importance of investment in infrastructure in particular. So it seems to me that anything that can be done to maintain the stability and the integrity of the 10-year national infrastructure strategy is the kind of thing that perhaps needs looking at. And I wonder, and that's why I've asked this particular question, whether it would be useful in some way to separate the capital stream out of the consolidated fund. If it's possible to reduce any of the prospects of tinkering with the flow of capital expenditure, it seems to me that that might be worth investigating.
Chris, thank you so much. I'm going to sort of ask Robin to come in on this. And I think what you are highlighting, Chris, is absolutely vital. Is how do we protect capital spending? How do we protect capital investment so that when we get these fluctuations that Ben has just discussed in response to several questions about, the fiscal space and where do we need to find savings or cuts, that, it doesn't fall on capital investment? Because we know from the 2010s that when we had, fiscal consolidation or austerity, a lot of this fell on capital spending rather than current spending. So yes, it's a really, really important question, especially given the infrastructure needs and in particular transport connectivity that Robin touched on in her presentation. So Robin, can I bring you in?
So it's my knowledge is that it is actually managed separately from the consolidated fund, though it's still part of the overall budget. So the consolidated part of it does come into the investment, but it is managed, so departments do report it separately. But if there is a way to sort of benchmark it more, so as in this money is just to be used for this, but it's also making sure it's over a significant time period and also considering how to get private sector on board as well. So having a bit more understanding of that. Yeah.
Okay, great. Robin, thanks so much. Chris, thank you very much for your question. Great to have you with us today. We've got 2 more questions and 3 minutes. So I'm going to ask for the 2 Johns to ask their question. That is John Geeb and John Edmonds. And then I'm going to ask for very, very short responses from our panelists, and then we're going to wrap up at 2. So can we unmute, John Geeb first of all, and then John Edmonds. John, over to you.
Yeah, a huge blow to government's credibility in the last 24 hours, and I agree with Ben that they've got to switch from we'll get prudent in 5 years' time to doing something today, which actually creates headroom. But can they wait until the autumn budget? Will the markets let them wait until the autumn budget to do that?
Fantastic, great question. John Edmonds. John, are you able to unmute yourself? Okay, let me read John's question while we try and bring him in. In Labour Party circles, there's increasing demand for higher income tax rates for high earners. The objection is that, however popular with disheartened MPs and party members, the yield is likely to be quite modest. Would the panel comment? John, I hope that's a fair reflection of your question. So very, very briefly, Ahmed, have you got any reflections on either of those 2 questions? And then I'm going to bring Ben and Robin in as well for sort of 30 seconds or so each.
Sure, Adrian. So, I mean, I'm going to comment about the taxes on higher income earners. So it's basically a popular move, but I think that it is likely to raise the revenues only modestly, and that's mainly because high earners are already very few, and there is a huge taxes on higher earners already, and such a move may respond. I mean, these people may respond to such a move to basically moving away from the labor market, or changing their behavior, as one of the attendees asked earlier. So, I mean, yeah, it's a move. It's a popular move, but I don't expect a huge revenue gain from that.
Great, thank you, Ahmed. Ben, perhaps on the first question about, is it possible to wait until the autumn?
Yeah, I think it's possible to wait until the autumn, because the autumn is when the budget takes place, and it's an appropriate time, an appropriate, fiscal event with which to deliver changes on tax and spend. I think perhaps doing anything in the meantime would be hasty and potentially engender even more uncertainty and unnecessary panic as well. But with regards to tax, I think there is movement to raise money through taxes, especially if the big three. Now, that's not politically popular. Nobody really wants to pay bigger taxes. But for example, if you were to raise the income tax bands each by 1 percentage point, you could probably raise in the region of 20 billion extra a year. That's back of the envelope calculation. But the current revenue raised by the government through income taxation is around 330 billion. So if you were raising 1% on each band, then you could still raise a significant amount each year. On top of that, there were the national insurance cuts, which took place under Jeremy Hunt, 2 of them. They were 2p each. I think the OBR scored them as essentially costing around 20 billion over the 5-year horizon, thereabouts, maybe slightly under. So if you, let's say, reversed one of those cuts, and then you also had the extra 1p on each tax band, you may be able to raise 25 billion extra a year. Again, it's not particularly welcome. No one's going to be happy to pay higher taxes. But in terms of stabilizing the ship and essentially building up a buffer against the fiscal rules, I think could go a long way, because at this point, it's really just about restoring credibility. Even if growth turns out to be excellent and you do much better than expected, that's fine. But it's just about giving yourself a bit of a safety cushion and a safety net if things don't quite materialize, rather than, gambling and being very, very close to the wire and then having to make these piecemeal adjustments every 6 months, which basically just leads to more uncertainty. So really, we want a stable forecast going forward, and we want the government to essentially say what they're going to do, how they're going to pay for it, and also what we think can actually be expected in terms of the tax schedule going forward as well. So I think saying that you're going to raise the big 3 taxes, perhaps, for the next couple of years, but then there's a sort of gradual taper off down to essentially stabilize the tax burden over the medium run towards the end of the parliament, I think is acceptable given the situation.
Great, thank you very much. And it's now just gone 2 o'clock, so we're going to wrap up. But before we do, can I first of all thank our brilliant audience for being here, for making time and joining us this afternoon, for the really fantastic set of questions and comments we've had. And if you've enjoyed today's event and you'd like to see more such events, put on by NISA, then do please consider becoming a member. All the details on our website. Membership includes, access to events, to speakers, to some of our analysis, to some of our researchers, including those here today presenting. So do please consider individual membership. We'd love to involve you more in our work, and it will also be a tremendous help and enable us to put on more such events. This event has been recorded, and the recording will be on our website. And that will include the set of slides that we've shown. So you can certainly watch the recording again and also see those slides at your own pace as well. Can I thank the team that's put on the event, led by my colleague Neil and Margarita as well. And can I also again say a big thanks to Ben, Ahmed and Robin for their fantastic presentations. Have a great afternoon. Thank you all very much indeed, and see you again soon in one of NISA's webinars. Bye-bye.